Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. As the year comes to a close, I wanted to draw your attention to the performance of the S&P 500 for the year-to-date period through December 26th, but also through the 3, 5, and 10-year periods. These are annualized numbers. This is the S&P 500, including dividends. I have also posted it here versus two sectors of the index, real estate and energy. But first, let's concentrate on the broad index itself, the S&P 500. That's the blue line in each of these four bar clusters. And you can see it's outperformed by a lot every year, or every bar cluster, the year-to-date period, the 3-year period, the 5-year period, and the 10-year period. Um, Real estate is the orange line. That's done poorly. And energy is the green line. That's also done mostly poorly, except for the 5-year period. It's actually beaten all the others with a 23.17% return. Um, but for the S&P 500, a 10-year period where it has a 14.87% annualized return, that's the bar cluster all the way on the right. Um, Behavioral finance says that investors suffer from recency bias. They think about what's happened recently and they extrapolate that onto the future. They think that's what will happen in the future, and it is a bias. It's not always the case. Don't think what's happened in the past will continue. Although the S&P 500 now has been doing very well for a very long period of time, but decades like this are rare. Almost a 15% annualized return. So we should all be careful about that. Now, if you're in a contrarian mood, this is not individual advice. I don't know everybody's situation, but if you're looking for something that hasn't done well that you think might turn around, real estate has to be a candidate or a consideration. If you look at the orange line in each of these four clusters, it's done poorly in each time period. Year to date, only up 2.19%. 3-year period up 7. That's certainly respectable, but not nearly what the S&P has done. 5-year period up 5.7. Also not terrible, but again, not what the S&P has done. And then for the 10-year period, real estate's up 4.51 annualized. Energy, much the same, except for that 5-year period. It's done very well, and that's because I think it did so well coming out of COVID. So that's the S&P 500 versus real estate and energy for the year-to-date, 3-year, 5-year, and 10-year periods through December 26th, through the day after Christmas. So almost the whole year this year. I should also add that about 9 years ago, I wrote an article for the Wall Street Journal using the research of a firm in Newport Beach, California, Research Affiliates, which I am fond of. I argued that based on their research, that real estate may not do that well over the next decade. It's done okay at 4.5% annualized, but not nearly what the S&P 500 has done. We could maybe call 4.5% annualized subpar. And the article provoked a bit of controversy. Fellow named Brad Case at NAREIT, NAREIT, the National Association of Real Estate Investment Trusts, which is a lobbying group for REITs in Washington, D.C. If you can believe it, REITs have a lobbying group. He wrote into the journal in response to my article and said, "We disagree with John Camarianos' prediction for equity REIT returns over the next 10 years based on data from the private real estate market rather than from REITs. Among equity REITs traded on stock exchanges, there has never been a 10-year period in the history of REIT investing when REIT total returns average 0% or worse, as his approach predicts." So REITs did better than I predicted. I think there was a mistake in the article, and I meant to say 2%, but still, REITs outperformed my prediction. But nevertheless, they've done poorly versus the broad market. You were much better off in the S&P 500. So NAREIT and Brad Case take that. We'll see if REITs start to outperform. Keep in mind the REIT index looks a bit different now than it did 9 or 10 years ago. 9 or 10 years ago, the classic property types were multifamily, retail, office, and industrial. All those property types still exist, but now the index is much more dominated by data centers and cell tower REITs. as you might imagine. So those are, in fact, uh, categorized as real estate. They're organized, those companies, as real estate investment trusts. They have to give back 90% of their earnings as dividends to maintain that status, and they do. And they are dominating the index right now. So the index looks a little bit different. Office buildings are no longer a major part of the index. The other three property types still occupy decent chunks of the index. Multifamily, of course, retail, a little bit less so with retail, and industrial. So that's the story with the broad market, the S&P 500, versus two sectors, REITs, real estate investment trusts, and energy. If you're in a contrarian mood, this isn't individual advice, but if you're in a contrarian mood, consult with your advisor, and you can take a look at REITs and energy. Perhaps they're poised to rebound. I'm not arguing that they are. REITs to me look reasonably priced, not too expensive, not too cheap, whereas the broader market looks expensive versus its own history. But again, the REIT sector looks different than it used to, and we don't know if data centers will pan out the way people are anticipating. There's been a lot of money borrowed and spent to build these things out, to build AI machines, large language models, and we don't quite know how those things will work and if all that borrowed money will pay off. So this is John Comarianos for Capital Considered signing off. Thanks for watching. Please click like and subscribe if you like our content. Thanks very much.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.